told you guys, I feel like the homework is a little weak in these chapters, so as we start to kind of go through the homework, I want to concentrate on the calculations as well as the concepts. Chapter 3. Exam number 3 is going to seem really long to you guys because you're used to those 50-point exams. So as we start to go through this, one of the things that I want to do is kind of concentrate your efforts on, like I said, the concepts, so you guys can understand what you need to be studying there, as well as the calculations. And then I'll try to boil it down to, I don't want to say I'm teaching you for the exam, but I'll try to boil it down to what I see as important and maybe some of the concepts that I see as being more important, so that as you're trying to go through all of these chapters and everything that you're being hit with, for exam number 3, you can kind of target where you need to do your study. So with that, let's go ahead and get started with the Chapter 9 homework. So the Chapter 9 homework starts out, and one of the things that they're trying to do is they're trying to reinforce to you that when you make an investment in stock, which is what they're having you look at, pretend like you own 200 shares of FedEx, and they're wanting you to look at your dollar and percentage return. And what they're reinforcing here is the fact that if you get a dividend, that's part of how you get paid back for owning the stock. But the other way that you would get paid back for owning the stock is by having the stock price hopefully go up. So when they have you do this calculation, they're having you look at where your stock was in the previous year. So it started out $103.39 per share. It went up to $106.69 per share. So that's where you're seeing where you would get a capital gain. But what you need to realize is that even though that's how you're getting paid back for owning that stock, you really don't get that capital gain unless you sell the stock. So it's only once you sell the stock that you really, and the accounting term would be realize and recognize that gain. So you're not going to have to pay tax on that gain until you actually sell the stock. Whereas with the dividends, you'll be paying tax on the dividend every year that they're paying those dividends. So you're getting the capital gain, but then you're also getting the dividend at 35 cents a share for your dividend. So then your total return is based on having the share price go up and the dividend that you're getting. So dividend yield and capital gains, that's all they're having to look at there. So I feel like that's kind of basic and that's algebra. Yeah, that's important to know. I think that's pretty, like I said, basic and it's algebra. So I don't really think that that's something that I'm going to test you too much over. These calculations that you're seeing then on column number 3 is also similar, but it's working with a bond. And actually what's happening with the bond is at the beginning of the year, it's $975, and at the end of the year, it's only $965. So I like this so that you can also see that if the price goes down, then you're losing ground. Okay. You're not having a capital gain, you're having a capital loss, but once again, you don't realize and recognize that loss unless you sell the bond. And then you would have your interest income that would be coming from that bond as part of your return. Make sense? When you guys get into the investment class, another reason why I don't want to spend a whole lot of time on this is when you get into the investment class, you're also going to think about where you need to be time-wise in your life in investing. So maybe when you're younger, you might want the growth stocks, you don't want to be paying tax on the dividends. Then as you get older, maybe you want the dividends because you want to live off those dividends. You need that cash flow, and you don't always want to have to be selling out of your portfolio to get cash. So once again, this is just kind of to set the stage for you to have a basic understanding of where those returns come from, so that then once you start dissecting out where you want to be and what return you want, it makes a little bit more sense. Problem number 5, looking at total risk. This is where what you had to do is you had to consider your coefficient of variation, and that would be one of the equations that you would be responsible for. So coefficient of variation is your standard deviation. And I said, if you guys will just kind of change the way the author is looking at it and just say it's standard deviation divided by return. So then any return that you're given, you can use then and calculate that coefficient of variation, whether it's an expected whether it was an actual return, whether it's an average of returns, it doesn't matter. You can still use then the calculation for coefficient of variation. So what's happening here is they give you three different investments. You've got one investment, the rail haul, that has an average return of 12%, standard deviation of 25. Then you've got idle staff that has a 15% average return and a standard deviation of 35%, and Poker RS that has a 9% return and a 20% standard deviation. So in the example that I gave you guys in class, I gave you one that was very obvious for you to see that there was more risk for the same amount of return. So it was really easy for us to understand then how that coefficient of variation was going to work. So now, in this practical problem, this is more practical, where you're seeing that if you were brought these three different investments, and remember where you would be standing with this right now is you would have evaluated all three of these investments, and you would have determined that the expected rate of return, or what you're going to get, is going to be greater than or equal to your required rate of return. So never forget that that's step one. Step one is you've got to look at that expected rate of return compared to the required rate of return. Coefficient of variation isn't helping you decide whether you're going to pick if something is viable on a standalone basis. Coefficient of variation is helping you understand if you only want to purchase one of these investments, they're saying risk versus reward, which one should you choose? And so what they wanted you to do is they wanted you to rank them from the riskiest to the least risky. So remember, the riskiest one will be the one with the highest coefficient of variation. So that's looking at the amount of reward that you're getting as compared to the risk that you're taking. So what you're saying then is, when you're looking at idle staff, the reward versus the risk is higher than the rail company. With the rail, what they're saying is the reward versus the risk is lower. So if you were going to try to determine, again, all of these viable for your portfolio, all of these on a standalone basis, they're saying that the return that you're looking at, you're expecting from them is greater than equal to what you're required, would be viable. So if I was only going to purchase one of these, looking at risk and reward, I would choose the one that has the less risk compared to the reward. So you would choose the rail company. Does that make sense? Does everybody understand the concept of coefficient of variation? I don't know if that'll be on the exam. It might be on the little take-home that I give you guys instead of the discussion board. So it'll show up again. Because I think that's an important concept to understand. Remember, don't get that confused with the reading about the correlation. We're not going to talk about correlation in this class. He only gives you like one page of information on it. And actually, then when you get into your investments class, you spend a lot of time looking at correlation. So it doesn't make sense for me to spend one page when you're really going to get in depth with it. And students take coefficient of variation and correlation and stuff in finance 340 because we just don't have time to, do enough examples to sort through materials. So coefficient of variation. Switching gears completely. Let me start the recording again. Switching gears completely, problem number 11. What we're getting into now is looking at portfolios. Remember, anytime I told you that you're dealing with a portfolio, you need to get the weight of each investment in your portfolio. So in this problem, that's simply all that you're doing. You're trying to figure out how much then of each investment, how much each investment is for the weight for that portfolio. So what you're doing is, first of all, you total up your whole portfolio. So you've got 6,000 in Adobe, you've got 5,000 in Dow, and 5,000 in Office Depot. So you've got 16,000 in your portfolio. So for Adobe, you've got 6,000 up to 16,000, so that's basically 37.5%. And then Dow and Office Depot, 1.25%. When you add up the weights, they have to equal 1 or 100%. I didn't do that here to show you that, but that would be one way to double check yourself and make sure that you haven't made a mistake. And if you look, I'm writing the weights in a decimal format, even though it's the percentage that's being held. And again, I'm going to do that because then if I need to go and take those weights times expected returns, then I can always go back and double check and make sure that my weights equal 1 or 100% and not get them confused with the returns. Because for me, if I start having too many percentage numbers in there, it's hard for me to go back and check my work. This just makes it faster. And I'm going to show you once we get to one. I would grade it either way on the exam, though. If you like writing 37.5% better, that's fine. Just watch your decimals when you start taking it times the returns, like you do in the next one. So in the next one, what's happening, number 13, is that they give you the weights that you have for each investment, and then they're giving you the returns for each investment too. So you're just simply having to try to get then the return for the portfolio by taking the weight of each investment times the return. So for example, let's just kind of talk through it. So for Oracle, it earned a negative 1.34%. It tells you down here then in the last sentence that Oracle is 30% of your portfolio. So that's why I'm taking the 0.3, and again, that's 30% to me, times the negative 1.34%. And again, I like to have my percentage returns in the whole number form because what happens then is that becomes the IY that you put in your calculator. So I'm going to grade you and make sure that you have your final answer in the whole number percent form. So it's almost easier just to leave it like that. Then you had Valero, which was 25% of your portfolio, and it earned 7.96%. So 25% or 0.25 times the 7.96%. Then McDonald's earned 0.88%, and that was 45% of your portfolio. So 0.45 times the 0.88%. So watching your signs, so when you take this 30% times a negative 1.34, you're going to get a negative. So double check that because that's one of the most common mistakes on the exam. Your total then for the portfolio should be 1.98%. So remember, for a portfolio, it's a weighted average. It's not a simple average. I didn't say negative 1.34 plus 7.98 plus 0.88 divided by 3. I couldn't just divide it by 3 because I didn't have equal dollars invested in each of these investments. So what they're saying is that McDonald's, being 45% of my portfolio, impacted the return of my portfolio the most. It was 45%, it earned 0.88. So I can't just add those 3 outcomes and divide by 3 because I have 3 stocks. I actually have to take how much each stock is impacting that return based on the weight. Number 16, I'm not going to test you guys on that. We're not going to use that. That's, again, something that you're going to use in investments. You're just getting, this is, and I think it starts to confuse people because when you're looking at 5 months of returns and you want an average for those 5 months, it is just a simple average. So don't spend too much time on number 16. I think it just confuses students at this point with what we're really trying to accomplish. So don't worry about that. Number 25, I like number 25. This would be something that you could probably expect to see on an exam. So number 25 would be a good one to study. I like it because they give you how much you have invested in each company, and then they give you the company outcome. So they're basically trying to make you first get the weights, and then calculate your portfolio return. So if you get something like this on the exam, first calculate out how much you have for your total portfolio. So they say that you own $5,500 in General Dynamics, plus $7,500 in Starbucks, plus $8,000 in Nike. So your total portfolio is $21,000. So to get the weights then, so general dynamics is 5,500 of the 21,000, so 0.2619, and again, that's 26.19%. I don't care how you write it, but I'm going to keep it in decimal format for myself. Starbucks is 7,500 divided by your 21,000, so that's 0.3571. And then Nike is the 8,000 divided by 21,000, so that's 0.3810. Once again, if you want to check your work to make sure you haven't made any mistakes, all of those weights should add up to 100%. Now we're ready to take those weights times the outcomes. So they say that, and I say respectively, so general dynamics is the first one listed, so the 7.44 is the first return listed, that's theirs. So general dynamics returned 7.44%, and that was 0.2619 of your portfolio. Then what they're telling you is Starbucks lost 1.36%, and you take that times the fact that it's 35.71% of your portfolio, but I put it as 0.3571. Then you have to consider that Nike lost 0.54%, and that was 0.3810 of your portfolio. And I actually showed you the calculations here so you guys can see what's going on, because I want you to watch what's going on, because if it's plus or minus, then it's a minus. And like I said, that's one of the most common mistakes on the exam. If something has a negative return, students forget to subtract it and they add it. So the negative return I have to subtract. So my portfolio return was 1.2571. That's the weighted average of all those returns in that portfolio. And I would expect something like that on the exam. Questions or comments on Chapter 9?
So after those calculations, you're dividing each of them by each other to get that on the portfolio return. How far away?
Okay, what I'm dividing, the only time that I'm dividing, so the question was, how am I getting the return? What's happening is I'm only doing the division to get the weight. The division is coming into play to get the weight. So general dynamics weight is the 5,500 divided by the 21,000. So what I'm doing down here then to get the total portfolio return, that's actually a times. So it's 0.2619 times the 7.44%.
Right, and then in between that.
That's a plus sign.
Oh, okay.
Okay. Oh, sorry. So that's what you were asking.
Yeah.
That's a plus sign.
Yeah, it looks.
Okay. Maybe make it a little bigger. Yeah, that's a plus sign between the parentheses. Any other questions or comments? Okay, Chapter 10. So moving to Chapter 10 then, and let me see if I can make it a little bigger, maybe that'll help. So in the Chapter 10 homework, problem number 1 starts out looking at the required return, and basically, expected return, sorry, I skipped it, I'm looking at number 3. Number 1 is expected return. And remember, anytime you see expected return, once again, you're going to get a weighted average of all the outcomes. So in this class, I would have to give you the probabilities. You're not going to have time on an exam to go figure that out. So the state of the economy will be given, the probability would be given, and also then the expected return then in each of the states. That's all going to be given. So all you really need to do then is simply take the probability of the outcome times the outcome. So there's a 30% chance of a 40% return. There's a 40% chance of a 10% return, and there's a 30% chance of losing 25%. And once again, I purposely am showing you guys what would happen if there's a negative outcome. You're losing money, you've got a negative. Because I want you guys to understand that that would be a subtraction then. Because you're adding all of those outcomes together, but you're adding a negative outcome, so that's a minus. It's plus a minus, so it's a minus. Going back to your algebra. So once again, it's not just a simple average. I just don't total all of those returns and divide by 3, because what you're saying is the slow growth has more weight. There's a 40% chance of that, and only a 30% chance of fast and a 30% chance of the recession. So no matter what kind of a chart I gave you, no matter what you're thrown for that expected return, all you simply have to do is take the probability times the return and then add all of those up in the end. And if you wanted to do it up here on your little chart to save having to write out that whole equation on the exam, that's fine too. That's showing me your work. So if you wanted to put the 12% up here, completing the chart, 0.3 times 40% equals 12, and you just want to make it as part of the chart, that's fine with me. Here's where I don't like what the author did with chapter 10. Because with chapter 10, our focus was on our SML equation. And remember, that's going to be the risk-free rate of return plus beta. And the beta is being amplified then, or looking at the market premium. I don't know what's wrong with the board. So what you're looking at then is the fact that the equation is I'm either going to invest risk-free, or I'm going to leave the risk-free environment, and I'm going to take into account the market premium. So that's return on the market as a whole minus the risk-free rate of return to get market premium, knowing that beta is only going to impact the market premium, and then beta is looking at the risk of the company then as it compares to the market as a whole. So one of the things I want to do as we go through the homework is I want to have you guys understand the whole SML equation as it pertains then to these problems, because the way that the author writes this, a lot of times what he's focusing on is only this right-hand variable of the equation, the market premium times beta. And to me that becomes confusing to students, because then you don't understand how the whole equation works. So he's saying in number 3, he said if the risk-free rate of return is 3 and the risk premium is 5, then basically what is the expected return for the market? So if you try to look at what he's trying to say, he's saying he's giving you the risk-free rate of return, and he's giving you the market premium this time, assuming that you have a beta of 1. So what's happening is, what you've got to learn to read for and understand is, if you're given market premium, you don't do the subtraction. Because the subtraction of market minus risk-free is to get you to market premium. So that's a concept. If you do that on an exam, you'll probably lose 2 points. So the concept is, if you're given market premium, don't do the subtraction. So if we were really going to establish an SML equation off of what he gave us, we're saying that the market is returning 8, the risk-free rate of return is 3, so that's how they came up with the market premium of 5. So had they said the return on the market is 8%, fill out your SML equation, that's when you would have had to do the subtraction to get to your market premium. So I want you guys to understand how the whole equation works. And the next one, once again, he's trying to have you be able to use the SML equation. And I wish you would have started with some problems where you could have practiced using the whole equation before he started kind of dissecting it out. Then he says the average annual return for a T-bill, so T-bill, remember, that's our risk-free, during the same time period was 5.6, so what is the market risk premium? So he's telling you market at the 15.8, and he's telling you the risk-free of the 5.6, and he's asking you to calculate out then your market premium. So once again, he's focusing on this right-hand variable, looking at total market and risk-free to get your premium. So basically the way the SML equation would have looked for this state, you would have had your 5.6% risk-free, plus, and then the 1 beta being the market as a whole, your market being the 15.8 minus your 5.6 risk-free for the 10.2% market premium. So anything that was moving exactly like the market would have had a required rate of return of the 15.8%. So once again, kind of get ready to stretch all of those concepts out to the whole SML equation, because unfortunately he just keeps focusing over here on the right-hand side of that equation. But you need to understand the whole equation when you're going out and making investments. Because remember, this is going to be, the SML equation is going to be how we come up with our required rate of return. Does it help that I'm showing you the whole SML equation? Does it make more sense where this concept is fitting in than with what he's giving you? In number 7, you have a company that has a beta of 0.65. The market, so again, what are they giving me? Are they giving me market premium, or are they giving me the market return? Well, this time they're giving me the market. So that means I'm going to have to do the subtraction in order to get to that market premium. So far I know the beta is 0.65. They say that the market is expected to have an 11% rate of return, and it says that the risk-free rate of return is 4%. So I'm just plugging this all into my SML equation. So risk-free is 4%. Then plus my beta, the 0.65, times 11, the return on the market as a whole, minus the 4%. So doing the math, I guess I didn't do the middle step, but 11 minus 4 would be 7%. Take the 7% times the 0.65 for 4.55 plus 4. That's how I'm getting the 8.55%. The most common mistake on the SML equation is an algebra issue. Don't forget, the way algebra is that you do what's inside the parentheses first, then you do multiplication and division before you do addition. So don't try to take the 4 plus the 0.64 times the 7, that's not how algebra works. Do what's inside the parentheses first, then do your multiplication and division next, then do your addition and subtraction last. So the rules of algebra are supporting our concepts, because beta impacts market premium to 7%. So again, algebra is supporting that concept, and then you're adding the risk-free. So you can either invest at risk-free and get 4%, or you leave risk-free, and over here in that second variable is where you're looking at the market premium you want for number 1, getting into the market, and then number 2, getting into that specific investment. So to take the concept a step further with this, let's think about it. We're saying that the market premium is 7%, the 11 minus 4%. We're saying that this company's beta is 0.65. Remember, the market as a whole has a beta of 1. So we're saying that you're not taking as much risk as the market as a whole, so we're saying you don't deserve the whole 7% market premium. You only deserve 0.65 of it. So again, checking your concepts to your calculations, you would expect what you're getting for a premium to leave risk-free 4% and enter into the market and buy this specific investment, you would expect to have this variable be less than that 7%. So once again, concepts as well as the calculations. Questions on that one? For problem number 9, company risk premium. So what's happening here is, once again, the author is just looking at this last variable. He's not looking at the whole SML equation. So he's saying, let's pretend like you decide that you want to invest in Netflix. And it has a beta of 3.61. So it's 3.61 times riskier than the market as a whole. It says that the market is expected to return 13%. So since they're giving you total market, you have to subtract out that risk-free. So what you're saying, or what they're asking, is that this beta is only going to impact the market premium. So beta 3.61 times the 10%, you're saying that you're going to have to get 36.1% premium over and above the risk-free of 3% in order to be willing to participate in Netflix. So the total required return then would be the premium that you would require to get into the market and invest in them. Don't forget your risk-free layer. So your total required return then in this type of a scenario to invest in Netflix would have been 39.1%. And to me, that's the most important part of the concept, is not just being able to calculate what premium you need, but being able to calculate your total required return.
So for the test, you're going to give us the full problem.
And so what you have to be aware of is what you're taking the beta times. Because if you think about it, if I give you the whole SML equation, I'm going to give you the risk-free every time, because you need it to fill out the SML equation. So your key is to know, am I giving you market, and then you have to subtract the risk-free out to get premium, or am I giving you premium? If they had told us the market premium is 10%, you wouldn't have subtracted out the 3%. So yes, on the exam, I'm going to get you to the whole SML equation. In number 11, I think there's a typo in the 3rd edition because there's no way that it makes sense. Because they're saying that you have a portfolio with a beta of 1.35. It says, what will the new portfolio beta be if you keep, and they say 85% in how your money is in the old portfolio and you have 5% in the new stock. Well, that would only be 90% of your portfolio. That can't work. And so in the 2nd edition, they had that you had 95% of your money stay in your old portfolio and 5% go with the new beta. So that's why I'm just saying let's use 95, because we know that this has to equal 100. So I had told you guys that anytime you're dealing with portfolios, whether it's a beta or a return, you have to get a weighted average. So what they're saying is that your portfolio, 95% of your portfolio is going to have a beta of 1.35. And then 5% of your portfolio will have a beta of 0.78, sorry. So your new portfolio beta isn't those two betas divided by 2, because the 1.35 has way more weight in your portfolio. That's 95%. So you need to get a weighted average beta, so my new beta then for my portfolio would be 1.32. When you're dealing with portfolios, what happens is, and I think there's one later, but if you wanted to get a portfolio beta, think about it, you could plug in your portfolio beta here in your SML equation and then just get a required rate of return for your whole portfolio. Again, each individual investment is going to have to stand on its own, but it would save you time solving problems if you just needed a portfolio required rate of return. So it'd be the weighted average. So I'm kind of a fan of that. 15. Oh, I see. We're just going back to the equation that we learned where we're looking at dividend yield plus capital gain. They're just trying to reinforce this to you. This was from exam 2, part 2. So we're just trying to reinforce that so that you guys remember the dividend yield and capital gain. I probably won't, I haven't decided. I don't know if I'll put this on the exam or not. I do have it on the review sheet though, because I have you guys calculate out your required rate of return for your retained earnings. So that's what we're looking at now. So we're saying if we do this calculation and we're looking at the shareholders that we have today, then this would have been our I sub S equation that we would use in weighted average cost of capital for our retained earnings. So again, I want you guys to remember this equation because then remember we've got a cost of external equity that starts to come into play then. Okay, and number 17, remember I will give you standard deviation. So this is basically the problem that we just had where you're taking the probability of the outcome of the state of the economy times the expected return. So you're getting a weighted average first of your returns to get your expected return. And then they're just having you calculate the coefficient of variation, but the author would have had you calculate standard deviation. I would give it to you. So what you're just doing is you're taking your standard deviation divided by your expected return and you're coming up with a coefficient of variation. This really doesn't tell you anything, though, because you're really not comparing it to anything. I mean, this problem really ends up not really having much of a purpose then, except for having you understand how to calculate your coefficient of variation by getting those expected returns for your denominator. Number 21. He gives you how much you own of each stock, and he gives you the beta, and he wants you to calculate out the portfolio beta. So once again, anytime you're dealing with a portfolio, you get a weighted average of what's in your portfolio, and then you can either plug in your betas or your returns. So this is nothing new. It's similar to what we did when we were looking at those portfolio returns. Only now we're plugging in the beta with the weights. So you've got 10,000 plus 7,000 plus 8,000, so you've got 25,000 invested in your portfolio. 10,000 of it, of the 25 is your Olympic steel, so that's 40%. 7 of the 25 is Rent-A-Center, 28%, and then 8 of the 25 is Lincoln Educational, 32%. Again, I liked it better in decimal format. So 40% of my portfolio has the beta of 2.2 with Olympic steel. 28% of my portfolio has the 1.5 beta with Rent-A-Center, and 32% or 0.32 has the Lincoln Education 0.5 beta. So my weighted average beta then, the beta for the portfolio is 1.46. And beta is not a percentage, so don't write that. Okay, 27, here's what's going on with that one. It says you hold the positions in the following table. What is the beta of your portfolio and what is the expected return on the market if the expected return on the market is 12%, risk-free is 3.5, what is the return on the portfolio? So I'm showing you how you can calculate it. The way that I like to do it is I like to get my portfolio beta first, because then I only have to use my SML equation once. If you wanted to use your SML equation for each and every one of these, that's fine, but then you have to take a weighted average of those returns. So I don't care which way you did it, but basically what's happening in this one is, and in 28 also, so I probably won't talk through both of them. Since he's telling you what the price of the stock is and how many shares you own, to get the total value, what you have to do is you have to take how much you own in each stock times the number times the dollar amount. So it's a little bit harder to do because you're just having to, and I probably should have taken some more steps to show you what's going on. But to get to my $17,660 total in my portfolio, it's because I'm taking the $40.80 times 100 shares, and then I'm adding to that the 3010 times 150 shares, and so on. So they just made you take another step. They didn't tell you the total that you had invested in each. You had to go number of shares times what they were selling for. Once you get your weights, you can take the weight then times the beta to get the total portfolio then. I'm just saying that first off, I've got to build my SML equation. So they're saying that you had 12% for the return on the market as a whole. And like I said, I don't care if you wanted to plug each of these betas into the SML equation. To me, that takes a little bit longer. But then ultimately, you've got to get the weighted average of those returns. I guess I'm a little lazier, so I get a weighted average beta. I say total return on the market was 12%. The risk-free was 3.5. Again, I went and got the weighted average beta, so I only have to use my SML equation once. So 1.42 is my beta. Then I can't forget that my risk-free sets out here as a separate variable. So when I look then at the return for the whole portfolio, it's going to be the 1.42 times the market premium first, then add the risk-free, and you get the total of the 15.57%. Again, number one mistake, don't forget, your goal is to get the market premium. The market premium is taken times beta before you do the addition. Usually it's an algebra issue. So then there's one on number 28 that's just exactly like that. I don't know if I would give you a table where I'd give you price and number of shares and make you do the math, or if I'll just give you the dollar amount of how much you have invested in each. I don't know yet. I'll have to build the exam and see how long it fills. If it doesn't add to the concepts by adding more calculations that take you longer, I usually don't make you do that. So my guess is I would give you the total you have invested. Otherwise, I'm just adding time and not really adding concepts. Questions on any of that before we go to the next chapter? So chapter 11, problem number 1, starting on page 397, cost of equity. So what they're trying to reiterate now is we've got different ways of calculating cost of equity. So the goal is to get a cost of equity so that we can plug that into our weighted average cost of capital equation. So what they're just doing now is they're just going back and doing more SML equations. So I don't don't think we're gonna have to spend a lot of time talking about that, because I think we've pretty much covered that in the last chapter. They're telling you the stock has the beta of 1.2, the current risk-free rate of return is 5%, and then they're giving us expected return on the market, so we've got to do the subtraction. Remember, if they give us market as a whole, we have to do the subtraction. If they gave us market premium, no subtraction. And I cut and pasted this from the author, so he uses the decimal format. Make sure that you give me your final answer in the whole number percentage. So don't tell me 0.152 or you're going to lose a point. It has to be 15.2%. Problem number 3. I like you guys to see this. I probably won't put this on the exam because to me this is just reiterating what you've already done with bonds, and I've already graded you on that. But what I like you guys to see is I want you to see it that you can do these calculations on bonds either from the company's perspective. So it says that they've got 20 million, that's the face value outstanding. When we did our evaluation of bonds, we did it on a per bond basis. It's going to come out the same. Whether we look at it as each bond or we look at it as every bond that the company has outstanding, it's going to come out the same. So in this one, what's happening is they're saying that you've got 20 million, that's the face value of these bonds, but they're selling at 97%. So remember what we had to get for our present value. Present value is what they're selling for. So 20 million times 97%, 19.4 million. Again, if we would have did this on a per bond basis, we could have said 1,000 par face value times 0.97. So don't let the 19.4 million throw you off. They're 10-year bonds. They're paying interest annually, so 10N. They have a 8.5% coupon, so they're 20 million times 8.25%. So again, we're looking at it from the company's perspective. They have to come up with 1.65 million every time they make a payment. Future value is the par face value of the 20 million. Calculate out the yield to maturity. So again, I like you guys to see that because it doesn't matter whether we're looking at all the bonds outstanding or a single bond. If you would have put 1,000 and used that for your par face value and 1,000 times the 8.25 and 1,000 times the 0.97, I mean, it's all going to end up being the 8.7115. And I'm going to show you that in another one later on because I do it the other way. But the goal then, why we revisit this, is because we're thinking of it from the company's perspective of having bonds outstanding. And put in your notes, then that yield to maturity, what we're looking at there is we would call that our cost of debt. Because in weighted average cost of capital, the concept is we're looking at the next dollar cost of debt. Well, we wouldn't want to use the 8.25. We wouldn't use the coupon. Because remember, the coupon was established a long time ago. It was established when they issued those bonds. We want to know when they went out and got debt today or tomorrow or the next day to buy assets, what interest rate would they be paying? So the market rate then, remember your IY was your market rate, would be the 8.7115. So again, kind of reestablishing those bond concepts but bringing it into the weighted average cost of capital arena. Number 7, we're not going to focus on preferred stock, but I wanted you guys to see one. What's happening, and they don't give you numbers, so you're just having to make something up, I guess, but you could also just use percentage, because you could say 8% divided by 97% and get the same 8.25, or you could think of it, my brain thinks in dollars. So I had to pretend like I had a $100 par value times 97%, so I said 100 times 97 would be $97. And then I would say 100 times 8% would be $8. So whether you could just simply take 8% divided by 97%, if your brain works like that, or if you need to see dollars, either way, the preferred stock would be costing 8.25. Because once again, you wouldn't want to just use the coupon rate of a preferred stock. You have to look at what the going market rate would be. So if people are only willing to pay 97% for that of the par face value of that stock, then you're going to drive up the cost. Okay, I I used the author's equation, and he's saying that your capital structure is 65% equity, 35% debt. So he's basically giving you equity divided by equity plus debt. You don't have to worry about preferred. And he's giving you debt divided by equity plus debt. So he's already done that calculation for you. So you're saying 65% of your weighted average cost of capital is financed with equity, the 13%. 35% is financed with debt, so that's the 8%. Remember, debt saves you tax, so take that times 1 minus the tax rate. So subtract that tax rate from the number 1. So then doing the math, 0.65 times 13%, do that. Then take care of this variable, 35% times 8 times 1 minus the tax rate, and add those together. And I probably should have shown that in our step. It's not like how you read. You do your multiplication. Do what's in your brackets first, do your multiplication, then do your addition. Does that make sense? Do you need my weighted average cost of capital equation on the board, or does it make sense? Can you see it? Either or. Do you guys want the equation on the board, or is it okay? Okay.
It's okay without it.
Okay, it's okay. And the next one, once again, he's telling you your capital structures. 37% equity. This time he gives you the preferred stock, 17%. Don't worry about it. It's just throwing in one more variable, but I won't give it to you. Then 46% debt. Then he's telling you how much each costs. So your cost of equity is the 14.5%. So 0.37 times the 14.5, take care of that. 17% times the 11% cost of your preferred stock. And then 9.5% times the cost of your debt being the 9.5%, and then take that times 1 minus your tax rate. So, I mean, this is just simply, the way he's writing this, you're just simply plugging in the variables. So hopefully that wouldn't be too hard. And the next one, what he's telling you is, what you need to figure out is you need to figure out, this is from a market perspective, what the market value of your debt is and what the market value of your equity is. So again, I'm not going to test you on this. So you're trying to get your cost of your bonds. So I would give that to you. So don't worry about that part. So the 6.8476% will be given. We've already tested on that. But then what you've got to consider is when you're trying to get your weight of equity, he's telling you that you've got, let me scroll back up, 3 million shares of stock outstanding that are selling for $17 a share. So your equity is the 3 million times the $17 a share. Your debt then, you've issued a $20 million, okay, don't worry about the coupons. The majority, I already took care of that. But it's selling at 106%. So you take the 20 million times 106%, and that's going to be the market value of your debt. So that's how you come up with the numerator for your equity and the numerator for your debt. Then the denominator for weighted average cost of capital would be your equity, market value of equity, plus market value of debt. So that's how I'm coming up with the weight. So when I take 3 million times the $17 a share, divided by 3 million times $17 a share, plus then the market value of the debt, 20 million times 106, that's how I get the 0.7064. Then taking the 20 million debt times the fact that it's selling at 106, divide that by market value of equity, market value of debt, that's how I'm coming up with the 0.2936. Remember, 0.7064 and 0.2936 has to equal 1 or 100%. If it doesn't, you've done something wrong. Your weight of equity and your weight of debt have to equal 100%. Then it just becomes, I'm plugging in. They told you your cost of equity was 14.5%. I will tell you your cost of debt. I'm not going to make you do the bond calculation. But then remember, your debt saves you tax. 23 is dealing with float costs, so this is when you're trying to calculate your cost of external equity. So remember, it's basically your dividend yield plus capital gain, but what's happening is you've got to take your float cost into account too. And remember, this is only from a company's perspective. Shareholders are never going to think about this I sub E. So they're telling you that it sells for $19.50 a share. They're telling you that the next expected dividend is 0.57 cents, okay, for 57 cents, sorry. And then they're telling you that it's going to grow at 4%, and you've got a 13% float cost. So I gave you two different equations on how to deal with it if it was a percentage. I stuck with the author since I knew that's what you'd be seeing. So what you're saying is that for every $19.50 that they're getting, they're not getting to use 100% of that to buy assets. Because 13% of that is going to go to who's ever selling the stock for them. So that's going to drive the cost of equity up, because instead of having $19.50, I guess I should have put the number there, they have less than that, but they still have to come up with the 57-cent dividend and the 4% growth. So what you have then for your cost of equity is going to be the 7.36%. On the take-home quiz that I end up sending you, I will give you something like what I showed you when we lectured, where I give you a balance sheet and have you guys calculate a weighted average cost of capital using the balance sheet. So remember, when I do that, accounts payable and accruals will be ignored, and you'll only be considering interest-bearing debt and equity to get your weighted average cost of capital. And we'll talk through that again. But I'm kind of running out of time if I'm going to get the exams handed back. So questions or comments on weighted average cost of capital? Like I said, I will